G'day traders. Before we begin, can I quickly remind you that if you're not jumping on our website, you're missing out. Over at thealgorithmicadvantage.com, you'll find a tools page where we share the data and the technology stack that we ourselves use, as well as our blog with a bunch of interesting technical articles. Most of them are on Substack. If you're interested in backtesting platforms like Strategy Quant X, Realtest, or you need reliable data like Norgate data, or if you want to learn Python for finance, it supports the show and our sponsors if you jump onto the website to investigate those. Speaking of Python, Jason over at PyQuant News has a new book called Python for Algorithmic Trading Cookbook. It's an awesome resource and it takes you through everything you need to know from sourcing free data to actual execution through the Interactive Brokers API. I can't recommend it highly enough. So again, jump onto our website to find your way to PyQuant News. And hey, if you're not a subscriber on YouTube, please hit the like and subscribe buttons. We really appreciate that. If you've got questions or feedback, could be good or bad, please just send us an email to info@thealgorithmicadvantage.com. And now on to the show.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Jason Buck from Mutiny Funds, welcome to the show. Real pleasure to have you here.
Thanks for having me, guys. I've been looking forward to this. You've had a lot of my good friends on, so glad we can make it work. And I always have to start with the disclaimer that nothing I say is investment advice. Nothing I say is life advice. I really wouldn't listen to some guy you just maybe met on the internet or listened to on a podcast, but we can start there, I guess.
Fantastic. Jason, look, you've got to give us a bit of a background. You've had an interesting path into finance. Like what got you interested in trading and funds management, and give us a little bit of your journey here.
Yeah, so I've I think I was joking about you guys off air. It's like Chunk and Goonies. Like, you know, when I was 6, I pushed my sister down the stairs. It's like I don't know. This feels like a confessional each time, and it's like basically, you know, I was an entrepreneur my whole life, and what fascinated me my entire life is actually wealth preservation. My great grandfather was an inventor, and he invented all sorts of things like for industry and machine tools. And he started a business that got passed on to my grandfather, passed on to my dad, and it was that classic third generation kind of shirt sleeves to shirt sleeves. So I can remember since I was like a mid teenager, like just really obsessed with like how do you keep, provide, maintain wealth if you can ever accumulate it, and you know, and how we all know how difficult that is in the first place. And it goes back to, you know, I bought my first stock at like 13 years old, you know, as a lot of people in this industry do. You know, I was starting, you know, small businesses in middle school, you know, selling to my classmates, all of those sorts of things. And then I think in probably late teenage years is when I first read Schwager's like Market Wizards. Those really captivated me way more, you know, so I started with Market Wizards more than I did even Warren Buffett, which eventually came around to that, reading those as well. But I think that's a real interesting dichotomy, as you guys know all too well, is, you know, our industry, to me, you either get your start with like value investing and Warren Buffett, or maybe you get your start with Market Wizards. And they're two, you know, distinctly different styles of convergent versus divergent trades. And I think it really affects the way we think about the world, depending on what was your like kind of entree in the industry. And then plenty of people have written about, you know, the different things that happen throughout your business or trading journey, how much those leave a mark on you. So like, to give you an idea, you know, I was a young man going into the GFC, and that was incredibly painful, and that really altered the course of my life. I mean, it goes back to when I was 19 years old, I think, was when, you know, you had those dot-com stocks raging, you know, and I was, you know, what we make fun of those YOLO kids trading now, and I'm like, I can't make fun of them because I was doing the same thing when I was a teenager. You know, why wouldn't you? But obviously those went bust, and then I was a commercial real estate developer in Charleston, South Carolina, in the U.S. And I built up, you know, developing a lot of this commercial corridor that's known as King Street in Charleston, that's well known today. And I was doing that going into 2007, 2008. And the bust happened in 2007 for real estate, 2008 for finance, you know, for financial indexes. But that pain of that experience was left an indelible mark on me. And it's one thing when you lose money for yourself, but when you lose money for your friends and family, it's unbelievably painful. And that process and that pain that I went through for years after that made me think about desperately, like, how do you kind of hedge entrepreneurial risk, or how do you hedge your kind of liquidity or GDP risk? And so I spent the better part of the next decade really teaching myself how to trade futures, how to trade options. I'd already been trading before, especially futures, going back to when I read Market Wizards. I got obsessed with futures from a teenager, but really came obsessed with options after the great financial crisis in the US. And then, after a decade of trading, VIX futures and intermarket spreads between VIX and S&P futures, trading options, figuring out, all my options Greeks, all that good stuff. I started tracking and talking to all the other managers in the vol space starting around 2014, 2015. And, as I was tracking them, this is when, Nassim Taleb's books became really popular after the 2008 financial crisis. And friends and family were like, how do I hedge my risk? And I was like, do you have $100 million? And they're like, no. Well, nobody cares about you. They're not going to hedge your risk. So this part of the industry, when we're talking about derivatives, options, even managed futures, it's very costly for people to get access to that. These are very institutionalized portfolios. As you guys know, even when you're trading managed futures, a lot of that industry starts at 5 to 10 million, even for a minimum allocation. And even to do it on your own with the size of the contracts, it requires quite a big grub stake even for you to DIY it. And then when you're talking about options and hedging, like I said, most of the institutional options hedgers start at about 150 million. Sometimes it's a billion notional of that equity beta they're protecting against. So it makes it really difficult. So getting to know this entire industry throughout that time, building these kind of total portfolio solutions for my family and friends, I realized I'm probably a better entrepreneur than I am a trader. And because I'm maybe a hardcore capitalist exterior, I have a deep, mushy, like hippie, dirty hippie interior. So I'm just a socialist deep down. And I thought there had to be a way to allow my family and friends access to these type of products. And so that's where that entrepreneurship kicked in. And I was like, there's got to be a way. So I, not only after teaching myself all this stuff, I spent another few years trying to figure out what are the best vehicles, how could I offer access to like accredited retail, around the world to products like this, because it drove me nuts that like my family and friends couldn't have access. And what I eventually figured out too is, as I'm building my own personal family office, I didn't have access to these products. But I figured out if I aggregate people like me together, then in aggregate, we could get access to these products and I could build portfolios that were robust and diversified and build exactly what I wanted. And so that's what we embarked on in 2020. And we started originally with a long volatility ensemble because that, once again, I thought that was the hardest thing people had access to was long volatility and tail risk. Ironically, we launched on April 17th of 2020. Which you'll know is right after COVID crash. And so, we were looking to launch this product in 2019 and early 2020, and nobody was interested, right? And then March 2020 happens, and now everybody wants, is interested, but everybody wants that insurance after the flood. And I didn't have a time machine, but I was, happy to get launched and offer our product then. But we were launching into a super high vol environment, which could have been, very difficult. And then it was after that, coming from a high vol to a low vol when you're running a long volatility fund. But what our clients knew that we pride ourselves on is we do a lot of education with our clients. And they knew that long volatility and tail risk is just a sleeve or a pie of your overarching, total portfolio. And so what we really try to educate our clients is what we now call our cockroach philosophy and our cockroach portfolio that we launched in September of 21. And that's more of a total portfolio solution. And I'm sure we'll get into like all the different aspects of that, but where your long volatility and tail risk is just kind of one sleeve of that portfolio. So I hope that gives you a bit of a background, but it's much more of probably an entrepreneurial background, bit of a trading background, but just scratching my own itches. And I just have an obsessive curiosity, and I just try to deep dive and try to solve problems.
I really like that obsessive curiosity. That's going to serve anyone well in life, I reckon. So walk us through the structure quickly of Mutiny Funds. Like, what have you set up there?
Yeah, so our overarching philosophy is called the Cockroach Portfolio. And the idea with the Cockroach Portfolio is it kind of muddles along in any global macro environment. And it's combining, what we call offense plus defensive strategies. Most people have, their financial advisor will show them a pie chart and they go, look, I'm broadly diversified. Look at all these slices in my pie. And I just point out that 99 to 100% of it's just offensive strategies. Those offensive strategies are like stocks, bonds, venture capital, private equity, real estate. They all do really well in kind of when a long GDP environment or a long liquidity environment. As long as everything's comfy, cozy, and everything's running along fine. There's the markets are awash in liquidity. Then those offensive strategies do great. And then, as we know, the phrase correlations go to one. As soon as there's a liquidity event or a sell off, all of those go down together. It didn't matter what you thought your diversification was. So what we try to really show our clients is offense plus defense wins investing championships. And we build ensembles of both offensive and defensive assets. And the overarching structure that we use that took me years to kind of figure out is we're technically a CPO, commodity pool organization. And what that allows us to do is primarily trade these derivatives of managed futures and options that are called 1256 contracts in the US for tax purposes. But the idea there is within a commodity pool structure, we're allowed to take accredited investors. And that was the structure we needed. And part of that is you're allowed to do unlimited accredited investors as a commodity pool. Whereas if I was in a traditional SEC hedge fund, you're going to be limited to that 99 investor rule. And that's why those hedge funds start at usually, $100 million minimums, because they're trying to get, into the billions of dollar range, where we can take hundreds of small investors and aggregate them up into something sizable.
Okay, so I think one of the curious things about what you've set up there is that in that commodity pool environment, you're aggregating other managers under yourself. So you're allocating to managers that you've selected. So you're outsourcing a lot of the strategies there, if you like. You've obviously looked at a lot of managers, a lot of traders, a lot of strategies. Um, I'd love to know a little bit about what you've learned through all of that. So, what do you look for? How do you do your due diligence? How have you pulled these guys together?
Yeah, I think the joy I get from it is portfolio construction is kind of like the apogee of a liberal arts education. As I said, I'm somebody with an insatiable curiosity. So I get to talk to hundreds of managers a year from the seat I sit in. But I have this weird dual seat as the CIO and founder of Mutiny Funds, is that, I allocate to a lot of managers. So we run it in a fund to fund structure, technically. We get SMAs with that. We can go into that daily liquidity as well. But then I'm also raising funds from our individual investors. So I kind of have a two-way street where a lot of people don't sit in that seat a lot. And I also come from a world where I traded myself in my own instruments and try to develop trading strategies. And what I find that was really helpful in doing that, especially this volatility space, especially the VIX future space, is a very kind of capacity constrained kind of small world. Like in the vol space, we allocate to 15 managers, but there's probably only 35 managers in the world. We track all of them, and we have them like Lego pieces. We can kind of add and subtract them as need be. But part of that, why I bring that up, is like I had to trade those VIX futures, intermarket spreads, et cetera, to learn what not to do or what to look out for. So that really helps me on that side. And then from my experience also trading, options and thinking about option structures, that helps us vet those like long options managers. And then going back to like trend following, from my teenage years, that helps me, being around this space for decades, helps me think through like what can happen and will happen, not necessarily what's happened in the past. It's that creativity you look for. So when I'm vetting managers, it's really interesting thing. There's a couple of ways to think about it. At the end of the day, the best due diligence we have is getting a separately managed account. That SMA lets me see their trading in real time, and basically they trade like a power of attorney. So I get to see their trades in real time. And let's say I had a long volatility manager that's all of a sudden losing his mind, he's trade short volatility. Well, I can go to cash immediately. So that's my best kind of due diligence. Beyond that, my other best due diligence is position sizing. So those are the two best ways to manage your risk. Because if somebody's a trader that's already registered with the NFA or SEC, right? They've passed a lot of background checks, right? If they're going to rip you off, it's going to be in a new novel way you've never thought of before, and they're going to be very good at it, right? So we do all those normal like deep dive of like due diligence that you try to do from trading and operationally and truly understanding what they do. But the real check you get at the end of the day is that separately managed account and then position sizing. So those are the things I really worry about when we're allocating to managers. So then if my position size is not large, it gives me a way to kind of ensemble these managers together. And the reason why we really use that fund to fund model is because I think, especially in the volatility space and somewhat in the commodity space, this is kind of the last bastion of active management. So to put these managers together, they're usually having institutional allocators, like large pension funds, endowments, right? And those people know how to put them together into ensembles similar to the way we do. But it's kind of a bit of choose your own adventure. And so what I think the retail audience misses a lot is they think that hedge funds by definition are kind of absolute return. They're absolutely not absolute return. They do very niche strategies that fulfill a part of an institution's portfolio. So you have to kind of put together multi-managers if you want to cover a lot of path dependencies. So what I'm trying to do through these ensembles that we use in the volatility space and the commodity space is I'm trying to get much more of a beta signal return from these spaces. Like if we take the traditional SocGen Trend Index, it's a great index for return. I mean, you guys will, we could probably deep dive on this, where it's great in general, but then, as you know, it's the largest 10 trend managers, right? They're constantly shifting in and out and survivorship bias. And then, as you know, the largest top trend managers in the world, they went for an asset gathering game. And so they raised large AUM, which gets them out of the smaller contracts, like, say, like a Coco that we can talk about. And they get them more in the financial side. So I may disagree with the way they construct their portfolios, but if you could trade the Stock Gen Trend Index, it would be a great thing to be able to have in your portfolio. But seeing how you can't, I have to go out here and build ensembles of trend managers and commodity diversifiers and long volatility and tail risk managers, because these are individual sleeves. And as I said, if these managers have $5-10 million minimums, it takes a lot of money to kind of aggregate an ensemble of these portfolios and then to be able to offer it to retail, which, as you guys know, is very hard to do. And that's probably why we're kind of the first of its kind to really build this for accredited retail investors globally.
So starting from the top, though, Jason, you're obviously bucketing, as you said, you've got quadrants. You're looking for managers to fit certain roles, right? So you said the vol space. I wouldn't mind if you could just quickly unpack that term for the newer trader and whatnot. Like, what do you mean by the vol space? But what are the quadrants or the spaces that you're looking at first and foremost that you want to fit these strategies into? Because that must be your first step.
Yeah, it helps to have a general philosophy. So the one we use for a Cockroach Portfolio is the 4-quadrant model. And just a little historical presentation, so to speak, is, proper portfolio diversification actually goes all the way back to the Talmud. You should have like a third each, and business, real estate, and cash was going, back thousands of years. But what we really think was a similar work was by Harry Brown in the early 1970s that he called his permanent portfolio. And the idea there was the 4-quadrant model was originally designed by Harry Brown, which was later copied by Ray Dalio, and he didn't give Brown any credit on it, which always irks me to this day. But the idea of the 4-quadrant model is that they're on the axes of growth and inflation. We're either in growth or recession, inflation or deflation. And those are kind of your 4 quadrants, and they kind of overlay and overlap kind of whatever current environment we're in. And when Harry Brown came up with the 1970s, he used stocks for growth, he used cash for recessions, he used gold for inflation, and he used bonds for deflation. And those are kind of the only instruments he had readily available in the 1970s. We just feel like what we do is a much more modern version of that. And so when we think about our portfolio, we also think about it from an offensive and defensive perspective as well before the 4 quadrants. So when we think about for growth, we use global stocks. So we globally diversify our stock positions. For deflation, instead of using domestic bonds, we use global bonds as well. We also use other strategies that we can get into, like carry strategies, et cetera, that should hopefully derive a little bit of income, because in a deflation or disinflation environment, you want kind of like a consistent cash flow that you should get from, deterministic return streams in those kind of environments. For the recession, instead of using cash, this is where we use long volatility and tail risk, because it gives us much more of a convex cash position. That's a great hedge when you have those liquidity events in stocks. And then in an inflationary environment, instead of just using gold, we use commodity trend followers. And we just feel they have a higher beta to inflation that can really offset the bond risk in that kind of environment where your bonds are going to get hurt. So those are our kind of 4 quadrants that we start putting in buckets into. We also use what we call a fiat hedge, where we still hold a little bit of gold and cryptocurrencies and a tiny allocation, just in case, global markets shut down. We actually even hold physical gold, just really for those chaotic events, because we're trying to really, manage, our clients' kind of multi-generational family wealth. And that's the idea, is like that broad diversification across the global universe is how we do. So to answer your question specifically, is like, think about, offense, we have stocks and bonds. Defense, we have long volatility, tail risk, and commodity trend. And then the idea within those buckets of volatility, the idea of volatility, the classic one you may have read with Nassim Taleb, is just kind of a deep out of the money tail risk hedging, which is like insurance, right? Your house, you pay premiums for your house insurance. Your house burns down, they write you a big check to make up for it, right? And so you're writing those premium checks every year, may go on 10, 20 years. You don't know when the event's going to happen. Then also it does happen. And now you've got that nominal value of your house to pay off, right? So typical tail risk is that maybe you're paying, a few percentage points every year in premium. It usually has an attachment point about negative 20%, meaning anything, below, negative 5, negative 10% drawdown in the stock market, they're not going to really hedge that. It's really when you get to that negative 20% and beyond that really truncates your left tail and creates that attachment point. The power of that over time is it allows you to hold more risk. You could be much longer your equity beta in those scenarios because you have this really permanently on tail risk hedge that's negatively correlated. So far I've talked about offense, defense, and the 4 quadrants, but we also think about correlations. And I know Rich loves the deep dive in this stuff, but a lot of correlations are conditional, But when you're buying that tail risk insurance and using those publicly listed put options, that has negatively correlated permanently on tail risk exposure to your stock. So it's permanently negatively correlated. And as we know with commodity trend following, it's uncorrelated. But the problem with uncorrelated means sometimes it's correlated with stocks and bonds, sometimes it's not. And so you don't have a real certainty there. So when we think about long volatility and tail risk, we think about this triumvirate of carry, convexity, and certainty. And carry meaning like what's the cost? If I'm talking about traditionally buying that insurance, it's a negative cost, right? You're writing those premiums every year. But you have high certainty if they're permanently on and they're on those listed exchanges. And then the convexity is there as well because you're buying hopefully deep out of the money puts for super cheap. And then when it comes down to your attachment point or your strike price, it's going to really have that convex cash position that we talked about. And so we think about building that portfolio that carries certainty, convexity. And what happens is a lot of people go, hey, I don't like that negative line item. I don't want to pay every year for my tail risk puts, right? I never am going to understand this, right? Like we have house insurance, car insurance, life insurance. We don't complain about those checks, but we complain about portfolio insurance. And people have a really hard time behaviorally doing this. But as Nassim Taleb said recently, is like, if you don't have portfolio insurance, you don't have a portfolio. To me, it's similar to like, if I have a coastal property, and unfortunately, this is really in the headlines in the US recently in Florida, I have a 10, 20 million, $50 million beach house. If I don't have insurance on that, well, the hurricane comes through, I no longer have a house, right? And the whole point is like, do I have the cash on hand to make up for that? Probably not. This is why I buy insurance, because you have that convex cash position. So that's the idea with the permanently on tail risk puts is it comes at a cost. So people go, okay, how do I lessen that cost? Well, now you have kind of what we call long volatility. And the idea in the long volatility space is like, I might look for when I think a fire, like a forest fire is going to spark off, right? Like I'm looking at wind conditions. I'm looking at the underbrush growth. I'm looking at what's the humidity content of like the grass and that underbrush. I'm looking at, our power lines going down. I'm looking for all these things to then try to opportunistically buy those tail risk puts. And it might be on both wings, it might be puts or calls. And the idea there is like, oh, I may be able to lessen the carry. I might even have a positive carry if I do this. But now I keep my convexity, but now I'm reducing my certainty. So those are the trade-offs when you're doing that. And so that's what we think about the long optionality part of the book is kind of doing a bit of those trade-offs. And then the other piece you have is like you can use in the volatility space is relative value volatility, which is a form of pairs trading where it's either the intramarket spread between VIX and S&P and trying to get those kind of right, or calendar spreads on the VIX futures contracts. All of those pairs trades are like typical kind of a mean reversion trade where you're trying to garner a little bit of income to hope pay for the premium on the rest of the book. The other thing that's really interesting, I think that most people don't talk about in the trend following space is you can actually we have managers that do intraday trend following on the market indices around the world. And what we like putting that in our volatility book is, if you know your options Greeks, is as the liquidity event happens, as the market starts to tank off, your implied volatility, your vega really expands. And so now you have a really conundrum. It's like, how do I monetize those puts? Do I roll those puts? If I monetize my entire position, there's a second leg down, I'm naked, but if I go to roll those puts, now the implied volatility is expanded. It's going to be much more costly. That insurance is going to be much higher premium. So what you can do with intraday trend following is you have the delta one nature of those contracts. You're not paying up for that implied volatility. So it allows you to short those market indices around the world, especially in like a second or third leg down scenario. So that's why we kind of like this total portfolio on the volatility side of using, long volatility opportunistically of trying to maybe lessen the cost of that. And we think about it in our moneyness from at the money to out of the money, deep out of the money, kind of overlaying and overlapping those paths as it goes down to make sure we capture this move, especially if it's once in every 10 years or so. You really got to make sure you capture that. So out of our 15 managers, if 5 don't monetize it correctly, hopefully the other 10 do, right? And so I'm just trying to make sure I'm trying to provide some certainty for our clients. And so we use that long optionality. We use volatility relative value. We use those intraday trend followers to short those market indices around the world. And then we still hold a little bit of permanently on tail risk puts because a lot of times things can happen over a weekend where maybe the market timers weren't in that market or market shut down. You want to have that permanently on tail risk. I know I just rambled forever, so hopefully that
15,
helps.
That does. So did you say 15 managers just in that space alone? So that's 15 different takes on managing volatility, essentially 15 different ways to insure.
Correct. And we'll probably get into this on the commodity trend side is like, we have a handful of managers you could argue within in volatility relative value, and you could argue there's only really like 5 trades there, but idiosyncratically, every manager is different. So this goes back to how do you pick managers, right? So if I'm looking at, especially in our volatility book, the first thing we look at is those paths of moneyness, right? And so what that means is like, are these managers trading at the money? Are they out of the money? Are they deep out of the money? And so like we try to overlay and overlap those first, right? And make sure we're covering it. So most of the book is just long optionality, right? You're spending a little bit of premium to hopefully have an enormous payout. The hard part is in volatility space is like, you know what you're spending, you don't know what your return is going to be, because how well do you monetize this? Because like volatility clusters, but volatility also mean reverts too. So as we saw like on August 5th of this year, or is when the Japanese markets tanked off, is like you saw volatility spike, but it mean reverted just as quickly on the market open. By the end of the day, by the end of the week, it was all the way back down. So if you didn't monetize any of those convex positions, you were just flat at the end of the week. And so you're trying to think about one, what are those paths? Also, the idiosyncratic differences is the way those managers think about markets, their monetization heuristics, make sure they're all going to monetize it differently. So that's what it's really about, is like having this overarching philosophy, having those 15 managers, so I get much more of a beta return signal from the entire space, but thinking about them in terms of they're each going to look at the market slightly differently, and they're all going to monetize slightly differently. And so therefore, people, a lot of times, institutions, pensions, endowments call me up. They're like, tell me the best long vol manager. I'm like, I would never think that way. And then also, if you do that and they don't monetize correctly, and we can get into what happened in 2022, you might have egg on your face. Like this was your long vol manager and you entirely missed it. And if this thing happens maybe once every 5, 10, or 15 years, you better make sure you monetize it. And that's why I think it's really important to use ensembles in this long vol space. And this is why I think this is the hardest space for people to wrap their heads around. And to me, it's like truly that last bastion of active management.
Jason, do you bring any newer managers in? Are you looking at, guys with lengthy track records, very well established?
So this is it's the opposite of the commodity trend space in this way. One, the vol space is fairly new. The hard part is the vol surface is constantly undulating and changing, and it regime shifts like every 2 to 5 years. And so a lot of times people will go, hey, here's my back test of long volatility going back 100 years. I just throw that out. It's totally irrelevant, right? You really can't back, like anything even prior to 2012 at this point is irrelevant, because then you had the rise of the ETPs in the vol space, right? As we had Volmageddon in 2018, et cetera, because of the rise of ETFs, ETNs, and ETPs. And so this space changes so much, you have to stay on top of it. The other part of this space that's difficult is a lot of these managers go out of business because behaviorally, like I was saying, it's very hard for people to maintain these positions. So a lot of times these managers are going out of business. This is why we track the 35 managers in the space, and we use them like Lego pieces. If they go out of business or change what they do, we can replace them with somebody else. So we're constantly kind of, watching, who's in the space, what are they doing? Because, we've had a handful of managers go out of business in the last 5 years. And so we always have to be constantly on the edge of what's in the space. And then we do look at new managers coming up. But to your question, there isn't really a lot of old managers in this space. One, because the space is new, but also because the idea, if you're short volatility, right, you're picking up pennies in front of a bulldozer, right? You're eventually going to blow up. And sometimes long vol guys, the counter argument is, they're going to bleed to death before they make money. So it's hard to find managers in the long vol space that have been around a long time. In the relative value swell space, that's where you can do a bit of both. So those managers have been in business longer. But there's only maybe 3 or 4 institutions, even in the relative value vol space, that have been around longer than 15, 20 years.
And before I let Rich deep dive into your commodity trend following and whatnot, can I just jump over to that equities quadrant?
Yep.
So, talking to your mate Eric Crittenden the other day, and he literally, runs half his portfolio on a buy and hold equities. If I do have equities in my space, like I'm pretty much just going to do it with trend following. Like, what's your approach to adding equities? What does that mean, adding equities? What have you done?
A great question. And I know Rich knows this history just as well as I do. Eric deserves unbelievable credit for what he's built, because everybody in the trend following space, as we all know very well with our good friend Jerry Parker, is trend following plus nothing, right? Like everybody in the trend space only believes in trend following. What I find too is I was actually, what I didn't include in my bio when I was starting my background is I was a comparative religions major in university. And so I'm actually, I'm very agnostic about life in general. So even when it comes to trading strategies, I'm very agnostic. And that really hardcore trend following is a faith-based religion, right? And that's why I never understood people are like trend following plus nothing or whatever, right? And it's Rich is right at the altar of that trend following. And so
it is.
And so
it is
what you
being
do
sacrilegious right now.
And it's crazy to me that trend followers, pride themselves on looking at the data and everything, right? But as soon as you put trend following with buy and hold equities, it improves the portfolio, like almost every risk metric of a portfolio. But I understand it's anathema for a trend follower to want to buy and hold equities, right? It's very odious. It sounds like, why would I ever do that? But when you put those together, it improves the returns of the portfolio. And that's why I think Eric deserves way more credit than he should get, because like, one, nobody from buy and hold equities usually wants to put trend following in there. And we all know the studies that show you should hold, 30 to 60%, but nobody even holds anywhere close to that. We hold 50% of our nominal portfolio in trend following. So I get it. And then if you look at the trend following space, everybody in the trend following space historically didn't want to buy and hold equities. So everybody hated Eric's idea. Now he's doing great with that idea. But that's what I loved about Eric is like, he just looked at the data and was very agnostic, is like, this is what works. So this is what I'm going to do. And so the hard part, like I was saying, though, it's like you can have, and I think Eric talked about this on your podcast, you can have netting effects too. Like I was saying, that uncorrelation of trend following means sometimes they're going to be correlated, they're going to be long stocks and bonds sometimes. And what I was banging the drum about in 2019, and even earlier, is like there's going to come a time when they're on that side of the trend and we have a liquidity event, which is exactly what happened in March 2020. You can have you could be holding long stocks and bonds. You can have a trend following that's long stocks and bonds. You have that liquidity event and your whole portfolio is going down together. So we can get into also the trend speeds later, but like that's a way to kind of think about it. And that's why I believe that buy and hold equities are a nice offset to a trend following portfolio. And going back, like we hold global stocks, which by the way, once again, you shouldn't do that either, because the US has just been ripping for the last decade and since 2009. So everybody thinks you're idiots to hold, global stocks to have emerging and developed, outside of the US, but it's just the right thing to do long term. And similarly on the bond side, we hold global bonds too. And I understand the argument too that like you shouldn't even hold global equities anymore because the US companies and conglomerates are really global stocks. And I agree with that. Their businesses are very global. So you could almost argue you get more of that diversification on the bond side by holding global bonds and kind of the different currency exposures than you get in the global stocks side of the business.
So you've got, you would just implement that with a range of diversified futures, contracts, equities, futures, global.
Yeah, so
like you're just holding on to them.
Yeah, I know I'm preaching to the choir here, but this is why I really wish people would read Market Wizards or really learn about the managed future. As you guys know, the naming in this space is terrible. But there's managed futures, CTAs, whatever it is. It's terrible naming conventions, and that's why it keeps people away. But when they truly dive into the space and they learn how you can diversify and manage your risk, and they'll realize the extreme capital efficiency of what we do, that's the true power of it, is that you get not only broad diversification, but you get great capital efficiency. So when we think about our book, I said that 4-quadrant model. Well, Harry Brown was 25% each: stocks, bonds, gold, and cash. Well, that portfolio is phenomenal. It usually does, 4 to 5% real returns, but it will drag behind like a 60-40 or stock portfolio for long periods of time. And people hate that, right? So it's that nominal return is not as sexy as they want. So what we do internally is we use that implicit leverage or capital efficiency you can get in the managed futures and options space, where we run each of those buckets at 50% each. So even though we're running these ensembles of fund to funds in the long volatility, tail risk, and commodity trend space, we overlay internally those global stocks and bonds using the managed futures markets because of that capital efficiency, and we just rebalance those monthly. We rebalance monthly too because we offer our clients monthly liquidity. And so that forces us every month to rebalance that anyway. So that was always what we did from the start. I mean, because you could argue for rebalancing bands, all this other stuff. But that's how basically, for ours, you're paying for the active management on the defense side. And then we're able to overlay for cheap using that capital efficiency, those global stocks and bonds kind of in-house. And those are just buy and hold and rolled every month.
How many managers have you got in that space?
So all the stocks and bonds are just global indices. Those are entirely, we just do those in-house. We use the trading asset through our back office at RCM Alternatives out of Chicago. That's what we just trade those in-house. We're starting to add managers in that offensive space. So I've spent the last few years talking to hundreds of managers in that space. So we're starting to put a little bit of pieces in there. But like I said, on the vol side, we're at 15 managers. On the commodity side, we're at 22, 23 managers now, and always adding more.
Rich, I better let you chime in because I know you're keen. Go for it.
All right, Eric. Look, what I thought. Thanks very much for all of that. I was wanting to bring it back to key concepts. So just so I've got a framework in my mind. So we're talking about a cockroach portfolio. Of course, the term cockroach automatically means something that you can't kill. So embedded in that is you're adopting, sort of expanding on Harry Brown's interpretation of effectively an all-weather portfolio where we've got 4 quadrants with an additional 5th quadrant of fiat. So you've got your growth, you've got your decline, you've got your inflation, you've got your deflation, and then you've got a fiat component to protect your purchasing power.
Yep.
So all of those aspects are basically looking at any possible risk scenario. And then within that, you use a term called fractal diversification. Now, I love this term because, the term to me implies getting into every single possible corner of risk. And so with fractal diversification, you're using within each of those quadrants, you're using this ensemble approach, uncorrelated ensemble approach in all quadrants, which is maximizing the uncorrelated properties of your portfolio. Hopefully, of course, correlations change over time, but you've also got a lot of structural uncorrelated properties in there with your long vol, your tail risk protection, things that they will stay uncorrelated by virtue of the fact that they're effectively an insurance or whatever. So we've got this structure in here. So let's bring it back to the whole reason this has been developed. Now, I'm assuming it's because of your recognition of the need for compounded returns over the long time, the need to minimize the adverse volatility of your geometric returns to maximize your compounded risk. Can you talk about that, and also in conjunction with, I know you've done some great papers on sequencing risk. So compound returns, geometric returns, sequencing risk. Can we talk about that?
Yeah, and as I said, fractals, it's shout out to Benoit Mandelbrot. As you heard me earlier, like volatility clusters, but it always mean reverts too. So like you get a lot of Benoit Mandelbrot in there. And the idea, is there's self-similarity in fractal geometry. What I love about Mandelbrot is, like, to me, geniuses state the obvious that's just never been stated before, right? Like, until Mandelbrot, we always think about things in Euclidean geometry and smooth shapes. And he's like, no, there's a roughness to them and there's a self-similarity to them. Like, if you think about a tree, and then I look at the branches of the tree, it's like a mini tree. And then I look at each branch and each leaf, it has a self-similar structure to the tree. And so similarly, like you said, we're thinking about offense and defense. Then we're thinking about correlations, correlated, uncorrelated, negatively correlated. Then we're thinking about the 4 quadrant models. And then each inside those quadrants, we diversify further inside those quadrants. And that's what we think about that fractal diversification. But you nailed it. The reason we do that is to make sure we kind of muddle along in any of those 4 macro quadrants, but also to make sure we compound returns effectively and efficiently over time by reducing that volatility tax, especially on the drawdown or those defensive side or inflationary environments. And unfortunately, we work with a lot of younger entrepreneurs, and I tell them, you took unbelievable concentrated risk to make your wealth. You got very lucky. Now to keep it, you're going to have to do an entire 180, broadly diversify, and to keep your wealth. And a lot of times that's really hard for entrepreneurs to flip their mindset around on that. And I get why. I've been there myself. But the other part that I think that the industry lies to us about is, like, a lot of times they show you annualized returns. And what you're talked about with compounding in your CAGR, your compounded growth rate, it's multiplication through time. And I don't think that's what we think about a lot, is the time component to it. And every year you have to multiply what that looks like. And that's what is hidden in this idea of your average annualized return. So we talk about ergodicity is a fancy word for sequencing risk. But one of the things that comes out of Ole Peters and the Ergodicity Institute is the idea that, the average ensemble is not the same as your individual time average through time. And that's the key to that is time. So there's easy ways to think about this is like, if I offer, you could play Russian roulette 1 out of 6 times for $1 million, you shouldn't do it, but you might do it, right? You might take that risk. But if I offer you $10 million to play Russian roulette 6 times, you shouldn't do it, right? Because it's multiplicative, not thinking about your expected value. And so a lot of times people are thinking about just their expected value and the average returns. And so where that shows up a lot of times is, if we study, global markets going back to the 1840s, so we have like 160 years of data, a lot of people will go, okay, well, like the US market has returned 77% real on average. Well, that's true and untrue, right? That's just, once again, is that ensemble of everybody since the 1840s, is that going to be your life path? And that's the difference in ergodicity, right? That's non-ergodic environment if your life path is different from the ensemble average. And this applies to a lot of the most of the things we do in life, but we always look at through the lens of the ensemble path. Whenever anybody's showing us portfolios, they show you back to 1900, right, on a 60-40 portfolio, and they go, look, it's just up and to the right. And you go, that's not my individual life path. My sequencing risk of what I live through can be very different. And so the idea of, like I said, like stocks for the long run has been disputed in the fact that, GMO just put out great research, I think it was last week, where they show even since 1900, there's been 6 occasions that average 11 years where in real returns, a 60-40 portfolio was underwater after 10 years. And a lot of investors aren't thinking about that because we have such recency bias. And so if the average real return after inflation of, like, say, the US market over the long term, 7%, what we're forgetting about is even since 2009, that's up to like 9%. And so, like, people are really having that recency bias. But if we look over the long arc of history, in the US, you have a 1 in 4 chance of that compounded return only being 2%. That's a vast difference, of a distribution of outcomes that we have to think about as we multiply through time. And a lot of times, if you look at the developed economies of the world, you actually have a 1 in 8 chance of being negative over a 30-year time horizon on a real return basis. And people go, okay, what does that mean? Is like, imagine, like even in the 2% return scenario in the US, if I'm 35 and I have 500,000 in savings, by the time I'm 65, I only have 900,000. Where if I thought somebody showed me the 7% average, I have over $3 million. Those are very different returns. And we need to think about those distribution of returns and how we think about multiplication through time. Another way to think about the sequencing risk or ergodicity is the idea of, like, 100 people, we say we have a great trading strategy. We know how to beat the casino. We all go to the casino to play blackjack. 100 of us go in, we're going to all go with $1,000. We're going to come back that day with $500, but one person's going to have a total risk of ruin. We go, great, I have a positive expectancy. Let's go do it. And let's say it's person 28. Well, the person 28 doesn't affect the overall group, and we have positive expectancy from 99 of us having positive returns. Well, the problem is, if you individually go to that casino and you can make 50% returns a day, by day 27 you're up $56 million, and you're thinking about buying islands off the Gold Coast. You're like, this is great. I'm just looking up real estate projects. But then day 28 you lose everything. Game over. There's an absorbing barrier. And so those are the things we don't necessarily think about with ergodicity. The other one that's classically, at least in the US, they always talk about is a retiring couple, right? They go to their financial advisor, they show them the glide path, they show them those average returns, once again, not what's going to be on the individual path. And they think, okay, here's your withdrawal rate, your inflation rate, you're good to go and through their entire retirement. But if we take, even in the US, 1966 through 1997, so a 30-year history, the average annual return was 8% over that period. But what you're missing is the first 15 years, the return was 0. For the next 15 years, the average annual return was 15%. Now, it depends on the sequencing risk you get as an individual. So if you're a retiree, if you go through that down period on the first time and you're taking those withdrawals, you could be broke in 12 years, right? But if you had the 15 years where you had the 15% returns, now all of a sudden you have massive returns and you're just fine. Or vice versa, if you're a young person just starting out in life and you only have a small amount of money to put away, if you have the low return period first, you only have small amount of money to compound, you're going to end up being fine, because as you get peak earning years, you're going to have the larger compounding years come in. But if you have those big earning years in your first 15 years of savings and then flat period for the next 15, you're going to end up in a much worse place. And so these are the little hidden things that we should think about with sequencing risk or ergodicity, that our lives and our market risk is non-ergodic. But these are the things nobody talks about, because I think it's really hard for us to think about. Like, I'm empathetic to it in the sense that, historically we were, agricultural, societies. And so you had many children and grandchildren. So that way, when you got old enough where you couldn't work the fields anymore to provide food and shelter for your family, you had a family that could provide that. But now we live in the world where we've abstracted this concept of money. And it's like, how do you hoard enough money to be able to provide for you in your retirement years when you can no longer make money? And I think that problem is way more pernicious than we're willing to deal with. And because we use these ideas from ergodic ideas and average ensembles approaches, that we totally miss the idea of the risk that we're truly facing.
It's interesting. when we're talking about ergodicity, these are technical terms which people obviously have a bit of trouble dealing with. But when you start understanding them, you can see how it starts linking to things like the Pareto principle. And I'll give an example here. So, in thinking of ergodicity, let's take an example. Why do so many fund managers fail to exceed the S&P 500 benchmark? And a reason for that is that in calculating the S&P benchmark, we're taking a spatial point in time and what all participants at that point in time are doing to be representative of the benchmark. But that's not how investing occurs. Investing's like a marathon. So if you can, if you start with a marathon with maybe 100,000 competitors at that start line, it's a 30-kilometer marathon. At the end of that marathon, you might only have 10,000 that get through there. So if you are looking at any discrete spatial point along that entire path and taking an average, you're going to start seeing how the time-based averages differ from the spatial averages. And this is why it is so hard to exceed that S&P 500, because it's a spatial average, a representative statement of all participants at a snapshot in time. What is the price of that benchmark represented by all of those participants at that moment? But the actual investing path, the time-orientated investing path, results in a significantly different trajectory, which so many people fail to understand. And when you include these absorbing barriers, as you're talking about, like, let's say you start with $100,000. Now, in finance statistical terms, when people start talking about stochastic calculus and these things, they're failing to recognize that there is an asymmetry in some things like wealth. You've got a 0 point. You've got $100,000, but when you get to zero, that's it. You're out of the game.
Yeah.
There isn't an infinite lower level and an infinite higher level to allow for this stochastic movement in both directions. There's an asymmetry created. And you see that with these conditional processes like wealth creation. You start seeing how non-ergodicity starts creating this path dependence. And I'm fascinated by this, and I think it's a hallmark of what I call, complex adaptive systems, in that over time we see this play out, and this path dependence, serial correlations, all of these things, which make terms such as averages so important to understand, and why, the geometric return is what we're striving for. If people could understand that geometry needed to create wealth without the adversity of that geometry, which really creates an asymmetrical drag on your overall performance, they'd see the light of day. So,
But what, Rich?
Moving on.
Before we get to that, this is the hard part, right? Like, we're talking about ergodicity, we're talking about sequencing risk, we're talking about stochastic processes and all this stuff. Like, we start talking about, you're maximizing the log utility of your wealth, right? People's eyes start to glaze over and they don't get it, right? Because, the way we should think about it simply, as I try to break it down, is like, if somebody's giving you averages, just assume that's a lie, right? You want to dig in and maybe learn more, right? For example, and then I'll even go back to when you're saying, why do allegedly, you hear this quote all the time, that hedge fund managers don't beat the S&P 500 index. The other thing that drives me nuts about that is like saying, the average ensemble of hedge fund managers, that's like saying, I don't like LLCs. Sorry, I don't know what the Australian equivalent is. Like, I just don't like companies. It's like, hedge funds do a lot of different things. Like, we go back to the beginning of my argument. It's like, hedge funds do very narrow niche strategies a lot of time. They're not absolute returns. So one, that makes total sense to me. The other thing that they don't talk about is like, let's just say, use rough numbers, is like, if the stock market returns 10%, but it has a 50% max drawdown, that's what they're not talking about, where that manager of that hedge fund might produce a 6 to 8% return. But if their max drawdown is 10%, that's going to maximize the log utility of your wealth. That's going to maximize your compounded growth rate. That's where you're going to end up in a much higher higher dollar amount when you go to retire. And so people are forgetting about those things. And then I put a finer point on it, is it's not only those averages and not thinking about compounding through time. The part of the sequencing risk that we're not thinking about is, what are we behaviorally do? So as I saw a million times, the stock market draws down over 50% in 2008. What do people do? They capitulate at 50% down. They crystallize those losses, and they're in such pain. They're in the fetal position. They're like, I'm never investing stocks again. So then they miss that mean reversion when it runs back up. So they've hit themselves on both sides, and they're not getting that average S&P return over time. Like it's a famous study with Lynch and the Magellan Fund, where I think he averaged like 28% return for almost like 2 decades, where the average investor had a negative return because they were trying to time his like NAV curve throughout time. And so we behaviorally do the things on our sequencing risk that hurt us the most. And that's why whatever that average is for millions of people over decades and decades, none of us actually get that average, because behaviorally we do different things because we have very different lifestyles and sequencing risk and behavioral adaptations.
That's exactly right.
I love the idea too for to bring this back to traders building strategies. This sequencing risk is an essential thing to be thinking about when we're doing robustness testing on strategies, right? Because what we want to know is that in a different sequence of events, we would still survive. Things could look very different, and that's part of building something that is robust, that we're aware of what it would look like under dramatically different circumstances, and we're still somewhat comfortable with that.
Well, what you guys are gonna
Sorry,
hate,
Rich,
you're gonna hate my part in this though. So the other issue I have that I think Rich has heard me talk about before is we have a non-stationary data problem. This is one of Eric Critton and I's favorite things to discuss privately, and that is whatever data set you're using to test your strategy on is regime dependent, and the future regime can look dramatically different from the past. And so no matter how robust a strategy we think we're building on past data, we're looking through the rearview mirror, and now we're going to have to trade through the windshield moving forward at high speed. And as we've all been through it a million times, it doesn't matter how good your backtest looked, and we tend to throw out the ones that are negative. The real life will always give you Murphy's Law if it never looks like that past data set. And so that non-stationarity means that like no matter what that past was, the markets can dramatically shift, and you can have a new regime that you never thought of before. And that's the issue why I'm not necessarily worried about AI or any of that stuff, because the training data is going to be past data. And you require what we call like centaurs, man plus machine, is the human has to imagine what are regime scenarios that we've never seen in the past that we could experience in the future. But at the same time, this is why I'm a deep fan of trend following, because it does have that nature to it where it's non-necessarily predictive of the future. You're trying to prepare for the future. And as you guys, I'm sure, have illuminated many times, we saw that with the cocoa trade. It had been decades since cocoa trended, but the people that still had it in their portfolio were able to do well off that, where the people that took it out of their portfolio based on recency bias did not capitalize on that trade.
It's interesting, Jason, when we talk about the cocoa trade, let's talk about Mulvaney while we're here. So I love the fact that this is where confirmation bias, hindsight bias comes in, because about 7 years ago or 10 years ago, when CTAs were having their little sort of spout in the winter decade of lost opportunity, as people sort of start talking about, they're all sort of commenting on how Mulvaney's performance was just, he was really lagging behind with his significant drawdowns. Yeah. But it's interesting, he's got a strategy that he hasn't really changed. It's a strategy that largely has remained unchanged at the portfolio level for the last 15 years. And yet his returns with the cocoa trade are the highest they've probably been historically when comparing over his track record. And this is sort of really stamping the approval on what you talked about, regime dependence. So, the thing that grabs me is that these markets are these complex adaptive systems. So immediately you've got to expect that they're not going to have predictable repeating patterns. Everything about adaptation is forward, time forward, technology advances. We don't go backwards in time. Things are moving ahead. So we've got to expect this non-stationarity going forward. We will never get a repeat of the past. We might get a rhyme of the past, but we will never get a repeat of the past, simply because these complex adaptive systems are always moving forward and adapting to new opportunities, new relationships, all of these things. So this really throws a question to you, Jay. What is the point of back tests apart from robustness testing?
It's a great question. I'm not even sure this is the hard part. I use them as intuition pumps more than anything else. So I don't think you can take a back test seriously. I use it in general as an intuition pump, and maybe we'll get into like, why, or combining them. The why I think it's interesting is like you said with Mulvaney. Correct me if I'm wrong, but like he's one of the few people that in the 1970s, a lot of these guys pyramided their positions in trend following. Nobody really does that anymore. And so I always like when I can't stand when options guys try to break the world always down to options, and they say that basically trend following is a long gamma profile, like a long straddle, right? And you have that convexity of buying both puts and calls, but you can also have the losses on the premium as on the whipsaws. But I argue it's not a long gamma strategy because to have that convexity, you would have to add your winning positions. And almost no trend follower does that anymore. But Mulvaney does, from my understanding. And that's maybe the primary difference between Mulvaney and others. Where, as you guys have pointed out all too well, is like everybody's gotten into the vol targeting argument, but people miss like the pyramiding of positions argument that I think Mulvaney kept on their books. So going back to like the back testing gives me a certain intuition pump, but I can't take it seriously. And this is where I think people get into trouble, is where they look at that back test and they go, this is my expectations moving forward. Well, no, that's not your expectations. But what I think is interesting when you're combining it at the portfolio level with all these other uncorrelated assets or different asset classes that have different return drivers, I believe, Rich, you call it uplift, right? Is that what you call it? Like that's interesting when you're not vol targeting, right? When you have uplift the portfolio that you can get from trend following. What I think is interesting, I think you need to add to that is like conditional uplift. So what I'm more concerned about is not necessarily the back test and the return profile or the whatever the Sortino ratio is of that actual trend manager. I'm more worried about regime dependent. Did they provide P&L in those regimes? And so that's the conditional correlation, right? Like I don't care how correlated they are. It's what's their conditional P&L when I have an inflationary environment. And that's when I need that uplift. So it's not necessary, and that because the rest of my portfolio, especially if you think about stocks and bonds, to me, they're very linear in those mean reversion strategies or convergence strategies, right? They take the stairs up and the elevator down, whereas trend following takes the stairs down and the elevator up. So it's much more about what are those conditional correlations, and can those managers provide that conditional uplift and provide really explosive P&L when you need it most. And but you can't, the back test it shows you a little bit of that, but you can't be guaranteed on the future. As you know, like 2008, after 2008, the trend followers and, Kaminsky and everything came out with like Crisis Alpha, and everybody's kind of backed away from that because, as you know, until it got to Q4 in that bond trade, you might not have had a positive P&L in 2008. So it's like, so going back to one, you can't trust a back test. You don't know moving forward it's going to provide the P&L when you need it most. And so this is also, and then as you know, in real time, it's one thing to run a long-term backtest of trend following and add it to a portfolio, and you go, look, this portfolio looks great, I'm going to do that. But the daily lived experience, as you know, trend following will break your heart. But the good thing about all of those things is that's why you don't have hundreds of billions of dollars in trend following or a lot of good strategies, is because they do have downsides to them that break people's hearts. And so this is why maybe you always have this ability to have persistency of returns over multiple decades that you see in the trend following space.
Yeah. It's interesting, people focus on correlation, and just because something's uncorrelated, they think, wow, that's fantastic. That's going to give me protection. But, I've looked at how trend following actually correlates on a time sequential basis with, say, the S&P 500. And what you'll find is that there are periods of positive correlation and there are periods of negative correlation. The sum total is it's uncorrelated, but it's going through regime shifts. It's going through regime shifts in different regimes, which is understandable when you consider how our trend following models work. In a bullish environment where stocks are going up, we're long that trend. When it's going down or short that trend, we're long that trend. We can start seeing how these regime shifts play. It's interesting you say that, because a lot of people talk about sample size, and I'm a big believer of, well, it's actually not sample size that's most important. It's coverage of alternate regimes, coverage of different regimes to test the viability of your models. So that's why I'd always say as much data as you can get your hands on for your robustness testing with your back test environment or whatever, to try and cover as many regimes as possible. Because, we know high frequency traders can get a massive sample size, but it's only over a very narrow regime, one regime or whatever. It's not reflective of how it's going to perform in a non-stationary adaptive context over the course of time. So, look, another key concept I'm wanting you to talk about is drowning in 2 feet of water. That's an article you wrote about. And so how can you drown in 2 feet of water?
Yeah, so this actually comes from Nassim Taleb. Is how can you drown in a river 2 feet deep? And it's once again beware of averages, the average of 2 feet deep river, and where the banks and the most of the river might be 1 feet deep, but you have a narrow channel in the middle of the river that's 20 feet deep. You're going to drown crossing that river. But so everybody told you the average was 2 feet deep. It's similarly like average temperature range of like if your house is a nice comfortable temperature range and that's your average, but then the bands around that average are 100-degree difference on in say Fahrenheit scale. Like that's very uncomfortable. So this is once again like why you have to be very, very, very careful of those averages, because once again, it's what are the bands or expected bands outside of that average that sum to that average return of whether it's a river that's 2 feet deep or the average nice temperature in your house. It's really dependent on what the standard deviation or variance of those return profiles are going to be like.
Nice one.
And then I want to go back to some of the things you said. I think that the data helps us with robustness. By the way, my other favorite one is Dalio says, right, you want 16 uncorrelated return streams. I'm sorry, that just doesn't exist. There's 3 correlations, right? It's either correlated, uncorrelated, negatively correlated. And the correlations are conditional. And we find out what those correlations are when we have a liquidity event like March 2020. So that's the beauty, like you're saying, if on average, and that's what I think trend following has to be careful of. On average, it's uncorrelated. Like you said, it can be very regime dependent. But the nice part is in inflationary regimes, that's where we really see the changing in those correlations, when we really just see those P&L uplifts that we get from trend following. And that's why I like your idea of uplift, but I also like to think about it in P&L, not necessarily correlation. And then how correlations are conditional, but that P&L is conditional. And that uplift, is it providing that uplift when I need it most in my portfolio? And this is why also when we look about it's by the averages of 2 feet deep. It's like if I look at like the SocGen trend index, right? I can talk about averages over time again. But once I said, like, if somebody says averages, you should be very careful. You should be reticent. You should look into the details. The problem is, as we know in the trend following space, the dispersion of returns between managers is enormous in any given year, especially like a year like 2022. So the way we think about it is like I said, I want to try to get like a beta signal return from that space. Is we start out by tranching them into short term lookbacks, medium term, and long term. Right, in similar trading styles, short-term trading style, medium-term, long-term, right? Because that's where we see a lot of the dispersion is kind of in the speed or look backs that you're using in your trading styles. And then inside of those short, medium, and long-term, then we look for like those idiosyncratic differences, right, that people have in-house, right? Do they use moving average crossovers? Do they use breakouts? Are they smoothing returns? Are they vol targeting? How are they charging their average true range? All of those things matter, and that's what we think about putting it together. An ensemble of trend followers is helping.
So time frame, system,
yes,
asset class,
yes,
the whole bundle.
Yeah,
and
Yeah,
so,
so this is,
you're looking at managers like Quest, Dunn, all of these different managers of their specialties, and then you're just putting small bets into each of them.
exactly. That's the way I
yes,
look at it.
this
Like,
partly answers the question, Jason, I guess, of this back testing and optimization and so on. I mean, you're taking a logical approach of allocating to 23 managers in the trend space, right? So you are trying to you're taking your own logical approach to averaging, spreading your capital across all of those different guys. So what's your philosophy there? You've just touched on it, but go into it a bit deeper. So you want to spread between time frame, I guess the way the kinds of models they are building. Can you talk a bit about the different models you're looking at?
yeah, and part of it, I also want to touch on something Rich said too. That like thinking about the robustness of your backtest, I would argue the robustness more in trend following comes from a pseudo Kelly criterion approach, right? It's when you're putting on those trades and you're using average true range or variance. I specifically use variance instead of volatility because it's not volatility. Is when you're position sizing those trades, that is what gives you the robustness more than anything else I find in trend following, is attenuating your position sizing to the current market environment. That's what keeps you from going bust more than anything else in the trend following space. So I just want to hit on that point that I think a lot of people miss from trend following, where that gives you the idea that you can count on the robustness is much more of like the Kelly fractional betting that you're doing when you're putting on trades. So like I was saying, is like the different managers in that space are going to have different look back periods. They're going to look at the world very differently when it comes to trend following. So to me, you want to really almost tranche those spaces in that short, medium, long term, and then you're going to have very different idiosyncratic ways to trade that. And I know you guys are been, for the most part, against vol targeting. I am too, generally, but also I think there's merits to it as well, especially in the portfolio context, right? So if I have a bulk of maybe medium or long term guys that are vol targeting, and I have guys that aren't around that, I can get that uplift or that explosive returns, but I can rebalance. So the other thing I think people miss a lot of times, Rich, especially in this space, is like if you look at the market wizards and everything, one, like I said, it was anathema to trade like just buy and hold stocks. But the other thing is, if you looked at their equity curve of trend following managers, every trend following manager would have told you, I would have loved to been have allocators allocating more to me when I was in the depths of my drawdown in my equity curve, right? But nobody does it, right? Because it's behaviorally very hard to do. When you think about our 4-quadrant model or tranching these different managers, and I'm monthly rebalancing, I'm forcing my scale to scale trade the equity curve of trend following managers. And I think that really helps to your compounding over time. You get a somewhat a rebalancing premium from that. So that's another way to look at when you're adding to those managers. And then in fairness, the bulk of our managers now, out of those, 20 plus over 2 dozen managers, a lot of them now we've added 16 diversification managers. And we went out and found all these old school discretionary kind of spread trade managers. And that helps that portfolio, one, from the rebalancing effect, but it also helps the carry for that trend following portfolio. So you're trying to like kind of smooth out the equity curve. So we're still trying to keep that full on high octane, as Rich would say, uplift that you get from trend following. But then we pair it now with these what we call our diversifiers, or discretionary commodity traders that are, old school guys just trading like pork belly spreads. That allows us to hopefully have a little bit of mean reversion in there too. That helps carry the trend following through those really tough times that are hard to live through. But also when you have those inflationary regimes, those discretionary managers are still trading commodities, so you tend to see an increase in P&L from those discretionary managers as well. So you get like a nice 1-2 punch out of those. But those are the way we think about kind of balancing out the portfolio a little bit. Is we have some convergent trades from commodities, and we still keep on a heavy allocation of those divergent trades.
Sorry, four quadrants. What sort of allocate? Is it sort of like an equal allocation to each of the quadrants? And your and you've also got your 5th quadrant, which is your fiat quadrant, or your purchasing power protection. What sort of allocations into each of those quadrants?
Yeah, so it's equal weight. So it's 50% each. So it's 50% global stocks, 50% global bonds, 50% volatility, 50% commodities, and then 20% to the fiat hedges. So that adds up to 220%. So that means for $100 cash in, you get $220 of exposure to these different markets. And
a bit of return stacking in here.
Yeah. As you know, my buddies. I to this day, Rodrigo deserves a medal for coming up with return stacking, because people latch on to phrases. But as they'll admit to, that's all portable alpha or capital efficiency. We used a lot of different names throughout the decades for these different things. But that's the whole beauty of it. Is like I was saying, is like as you're reducing that volatility tax and you're reducing the bands of expected returns, you are inevitably, with this proper diversification, going to be reducing your return profile. So you can use a little bit of that capital efficiency to get it to a sexier return profile that makes a lot more sense. Also increases that rebalancing premium if they're truly uncorrelated and negatively correlated. So that's the way we think about it. So we offer our clients that capital efficiency effect that they can get from that. So especially, we're trading all the world's liquid markets. Well, if they have a lot of private markets and private equity and real estate, they can kind of equal allocate to both. So now they have a very liquid and illiquid portfolio, but their liquid portfolio is very capital efficient and has monthly liquidity. And that pairs really well with these illiquid privates that have a granularity issue of trying to get your money allocated over time and get your money out is very difficult. But that's why it pairs very well, and that's why we try to offer that capital efficiency. And then I was saying it helps you scale trade those different return drivers from those 4 quadrants. And also the reason I think you're alluding to is like we use equal weights to those quadrants, because it's part of my agnosticism. Is like Dalio, like I said, copied Harry Brown's 4-quadrant model, but then he leveraged up the bond side. He used, that's what risk parity is trying to equal weight the vol. Well, you're equal weighting that vol and correlation on a back test, and you don't know what the future is going to look like. And honestly, if you
that's a predictive stance, isn't it?
Yeah, if you did that in the 1930s, you would have blown up, right? So like, over the long term, it's kind of 1 over n. Like these things over the very long term tend to have very similar risk profiles, but over a few intervening decades, you might fool yourself into taking more risk than you should.
Kudos to anyone who listens to a Jason Buck podcast on 1.5 speed, because they they are pretty bright.
When I did Top Traders Unplugged, they reached out, Niels reached out and said that their producer said I used 160% of the words that the average podcaster used on there. So like, this is just a value podcast. You're just getting more for your money.
Excellent. Well, before we do wrap up, I'm going to throw 2 questions in at once then. I was asking before, where do you find these guys? Like you're casting the net pretty wide. I'm curious about that. I'm sure other emerging managers are curious about how to get found, and and then I want to ask about the on the trend following side. Like you've got different speeds. You've got some really short term stuff going on there too. So I'd like to know you're thinking about that, like shorter term than a lot of your regular CTAs.
Yeah. So let's see. How do I find people? Like starting the vol space, like I said, trading it myself and then really starting to get to know the other managers around 2014, 2015. And I started tracking a lot of them. So I found them, just on my insatiable curiosity, deep Google foo searches and all that stuff. On the trend side, part of our back office is a joint venture with RCM Alternatives out of Chicago. Those guys have been in the commodity space since floor trading days, and they have some of the best databases you can find on trend following. So I lean on them heavily to source a lot of our commodity managers. And they also run, like, to find those discretionary commodity managers that don't really exist anymore. I mean, they have offices in Memphis and everything where you can still find some of those guys. So those are really hard to source. So it's both using the platforms like RCM or other database platforms. It's deep Google searches. It's just me being, public in the space and just talking to anybody and everybody. On our website too, managers can reach out on our website. There's a section on our website where you can even, like reach out to us and, kind of upload your pitch decks and everything. We're happy to take a look at them. I look at, hundreds of managers a year. And then it's, being on stages, being at events, like iConnections down in Miami, like Alternate Hedge Fund Week, MFA, iConnections, those sorts of things. Those always help. And then Simon, help me. I forgot the other part of the question.
So trend following,
Yep.
you do some really short term. I believe you even said like intraday, daily, couple of days. That's pretty unusual in the CTA space. So talk to us a little bit about that.
Yeah, so this one's hard where it starts to overlay and overlap. The problem is, I think historically, as Swenson's kind of Ivy League model, is people start getting these allocation buckets. And I think a lot of managers, and you guys probably feel this sometimes yourselves, is like the allocator will go, well, it doesn't fit nicely in one of my buckets. And like, that's heartbreaking, right? And so even though we have these buckets, I can think a little bit more creatively about it. And you might argue that some of these cross over. Like I think the hardest one is actually like medium term and longer term trend following. Most of them are going to kind of cross over between those. Like, how do you argue what's medium and how do you argue what's long term? We can kind of like talk about whether short term you're looking at, you're kind of looking at a few months, where medium term you're looking at 6 to 9 months or 6 to 12 months, long term 12 months and longer, or those 251 day or longer look backs, those sorts of things. So those can kind of cross over a little bit when we're looking at them. And then what I reference is the intraday trend following. That's incredibly hard to do. We put those in our vol bucket. Some of those could argue you could put those in our trend bucket, but to me, that's more of a volatility piece because they're intraday, so they're out by the end of the day or the end of that trading session, depending on globally or regionally what you're looking at. And, it's also like you're not even using margin for that. So it's a very unique kind of prospect. But then I don't know, I'm trying to think regulatory wise if I can start throwing out names, but Rich threw out some of the biggest names in the space that are great short-term traders, great long-term traders. We try to look across the space and kind of look at everybody there and just look for those tiny idiosyncratic differences.
Actually, have you ever looked at stocks then, Jason? Like anyone trading stocks, you've got those buy and hold sort of stock positions.
Yeah.
Any stock trading strategies that have come across your desk that you've been interested in?
Yeah, so trying to think about this from multiple perspectives. One is like if you think about what Jerry always talks about, like they trend follow on stocks, and Eric Crittenden wrote a great paper even back in his like Black Star days about trend following on stocks. Especially if you can use kind of the future stocks, and it kind of works. I've never been a big fan of shorting stocks because I just think the market is working against you. It's a negative EV trade in general, just because of the way the market setup is. Like Rich is almost saying, you have the absorbing barrier of zero, right? It's kind of a negative expected value strategy to short stocks, and you can blow up in your face. So I don't necessarily love single name equities. But then as we look at that buy and hold, once again, you're trying to get that uncorrelation. So I don't want to overlay trend following on it because then it's become correlated to my other trend strategies. What we do look for in the equity space that we have been talking to a lot, we maybe allocate to a few or work with a few, is like the pod shops that are doing like those long short trades, market neutral, factor neutral, those sorts of things are just grinding out returns. Why I say they can go in the stock bucket, or once again, it doesn't fit neatly in that bucket, but it does fit in the bucket of an offensive trade. Right? It's implicitly a short vol trade or a mean reversion trade or a convergent trade. So I don't mind putting that in our offensive bucket. And you can grind out great returns on a great Sharpe or MAR ratio until eventually you probably experience a left tail. But then we have the rest of our book that can handle those left tails. So like that's why I don't mind. It's really hard to do. Even for me, I implicitly I think I'm a long vol guy. just one of those weirdos. And so it's really hard for me to put on a lot of those short vol trades, but I know how they fit in the rest of my book and what's the emergent quality or properties of the rest of the book. So I don't mind diversifying those in a way. But then it's a function of where, like I started with, we're a commodity pool operation. And part of that is like, you have to just trade those 1256 contracts, those managed futures and options derivatives on managed futures. And so you have to stay away from securities. So that's really difficult for the space, but also like, because like some of my best friends just down the street here are like some of the best micro cap managers in the world. And I'd love to allocate to them. So I'm also exploring, whether we do an interval mutual fund or all these other different wrappers that you can get in Europe, et cetera. For maybe being able to open up the world of securities for us, because in a way, my hands are kind of tied behind my back a little bit of only being in like kind of managed futures and option space.
Yeah, it's crazy, that regulatory divide, and I think it's a particularly US thing. And I don't know that it makes any sense to a modern guy coming to finance, like why we would have this divide. And I think it's I don't know, but I imagine it's largely because of the regulators in the US being divided between the SEC and the CFTC, and I don't know.
Well, it's in the name, 40 Act. It's 1940. This is the laws we're dealing with.
Yeah, we're dealing with. There you go. Yeah.
You should see, like, even the ones like, as you know, for this podcast in the US, all the rules by the NFA are written on newspaper ads. So I'm like trying to interpret their rules and regulation around newspaper advertising to like social media marketing and like podcasting. So that's the difficulty. And like, it's always so funny when Corey Hosty and I were doing Pirates of Finance, we used to have people go, hey, will you do, videos or documentaries? What's a day in the life of a hedge fund manager, which would be great for like the people that follow you guys too. And I go, I don't think you want to see that. They're like, why? Because I think they think we're, just slinging stocks on a Bloomberg or something. It's like, no, most of our day is in compliance and regulatory and lawyer meetings. It's really boring stuff because the regulatory burden is so high that you spend the majority of your time on the business of running a hedge fund, not on actual trading.
It's not like Billions.
No, that show is so bad. I just can't.
Jason, what are your future plans? Like, are you working on anything new? Any plans for future projects, that sort of stuff?
Yeah, when you said future plans, I was like, God, I hope I live to tomorrow. First of all, I think long vol guys generally have very dark senses of humor. I think it carries into trend following as well. But you're
a long way away from your absorbing barrier.
Exactly.
Jason, don't worry about it.
You never know. And then the way I think about it is kind of what I've been hinting at is, we have this cockroach philosophy, and this is to me the 1.0 version. The 2.0 version is combining all these private assets with that liquid portfolio sitting on top of it. So it's one thing for people to allocate to us that have privates, but the beautiful liquidity profile you have and that capital efficiency is going back to return stacking, or what we call portable alpha, is, we're sitting on a lot of cash, and we could be using that cash for those discretionary privates like private equity, venture capital. And those, once again, are offensive strategies. Those are just leveraged stocks and bonds. Those are not alternatives. But I don't mind putting those in my offensive portfolio. And as Cliff Asmus would say, volatility laundering, having those great return profiles. I'd love to have those in my portfolio. But only overlaying with that long ball defensive side that we get from commodity trend following and long volatility and tail risk. I think that has a really symbiotic relationship that hasn't been combined properly before. So that's what I'm excited about on the future of this business. And then, other things that are nerve wracking is I sent you guys a Notebook LM podcast of our entire white paper that we have on our website. And it just makes you question, like, how long are we for this podcasting, social media kind of?
Just give our viewers a bit of a sense of what you did. It was a fantastic 13-minute presentation. So just explain what you did.
Yeah, hopefully, I think shortly, I just want to make sure regulatory wise we can do it, but we should put it out on our Mutiny Investing podcast. But we have an 80+ page white paper that really goes into a deep dive of our cockroach investing philosophy. And it goes through every asset class, everything. So what we did is we fed that paper into Notebook LM, Google's new LLM for podcasting. It took less than 5 minutes. We didn't give it any other instructions than to summarize the paper into a podcast. It created a 13-minute podcast that had two of the Notebook LM, a male and a female. And then they did a better job of summarizing that 80-page white paper than we've ever done. It was quite embarrassing, actually. And then they even had it felt like almost, I fooled my father-in-law with it. I had played it for him and he was like, who's that? I'm like, oh, this couple, they love our portfolio. And because as you guys heard, it had like these ums and ahs and these interstitials. And and this is just version 1. I mean, there's the little things.
I couldn't tell it was AI. It was just amazing. And I thought, but shouldn't Jason be presenting this?
It broke my heart. So yeah, the version 2 is we're going to upload my voice in there, which I disagree with. Like we have a girl on our team from South Africa. Her voice is much better than mine. I'd rather her do it. But like, I think people have gotten somewhat used to my voice. But yeah, it's just shocking. That one really messed me up this morning. I was for a good hour. I was just kind of aghast of like how good it was. And I think that the hard part people don't see how good they are is because we wrote that paper. I know every detail of that paper intimately. It's stuff I've been working on for 15 years. And for them to summarize it, there was no like hallucinations that you get with a lot of GPTs and everything. It was spot on. It didn't have like anything wrong or I would disagree with. And that was more shocking to me than anything else because I expected it to be like, off here or there and need a lot of kinks to work out. But it was dead on immediately and it sounded like two real people. It was really shocking this morning.
It was pretty good.
God.
Anything else, Rich?
Be, next 2 years, imagine. Anyway, no, look, you've exhausted me, Jason. It's been a fantastic chat, and thanks very much, mate.
I appreciate you guys.
We really appreciate it, Jason. Jason, before we leave, let us know where people can contact you, the website, that kind of thing, Twitter.
Yeah, so I think the best place to find us is at mutinyfund.com. That's singular. And that's where we can find a lot of these insights that we've been talking about. You can also find all our pitch decks, return data, all that frequently asked questions. We have videos on there, everything. Hopefully pretty soon we'll be putting this Notebook LM synopsis of what we did in the white paper, but you can find the white paper on there as well. That's at mutinyfund.com. And then you can find me on Twitter X at Jason C. Buck. And then, podcasting, we have our Mutiny Investing podcast, and you'll hear me on great podcasts like the Algorithmic Advantage.
Indeed. Actually, there's a infographic you've got on your site. I actually really like that. I might repost it as well. But it's just this great summary of the full diversified approach, and it just shows everything working together. And it's a real advertisement for every kind of diversification you can imagine to survive every kind of event. And I like the way you put that together. It looks really cool.
Thank you. We appreciate that.
All right. Well, thanks once again, Jason. We'll chat soon.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.